One of the opportunities I think that investors are going to have over the next couple of years is companies that came public or gained notoriety during those boom times during the pandemic where valuations just went absolutely insane. And then stocks dropped like a rock and actually fell below where we should actually be valuing these companies long term. One of the companies that I have been very negative on for a very long time is Blink Charging, and in large part because the company was valued so highly. At its peak, shares were trading over $50 per share. This was a multi billion dollar company that had just a few $1 million in revenue and no signs of getting anywhere close to profitability. Well, fast forward to today, the stock has dropped almost 95% from its peak. The business continues to grow and it's getting closer to profitability. So it's now much more intriguing from a risk reward perspective than it's ever been, I think, in its history. So today I want to dig through why I'm more intrigued by Blink Charging today than I've ever been. A lot of it has to do with valuation, but a lot of it has to do with this business maturing and understanding where we may actually see some positive financial results in the future. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video's sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. So let's start with Blink Charging's stock and actually what this company does, because I think that's important to understand as well. Here you can see Blink Charging's stock price before the pandemic. Shares were trading in the $1, $2 range. And then shares went all the way up to over $50 per share in early 2021. Just a crazy run for the company. I remember it started showing up on CNBC, and investors were incredibly bullish on all things electric vehicles. That has obviously trailed off very steadily over the last 3 years. And now we get to where we are today. Shares are trading at about $3.35 per share. But over the past month, there's actually been some recovery, and there's a good reason for that. I'm going to get to that. I'm going to get to that in just a second, but I do want to cover what exactly Blink Charging does, because I think this has often been misunderstood. Blink Charging is a electric vehicle charging manufacturer first and a network owner second. I'll get to their financial results, but there's multiple businesses that all really operate around building and designing the chargers themselves. So they will hybrid own a charger. They will do Blink as a service where you're going to pay a network fee to have a Blink charging system available. They will own the system themselves and actually share a portion of revenue with the host. And most of their business is actually host owned. So this is where a business is going to buy a Blink charging station and just install it themselves. If we look at their most recent financial results, this is really where you see things lining up. Product sales, so this is the sales of a charging station, is a vast majority of their business. $35.1 million in the most recent quarter that's been reported. We don't have fourth quarter numbers yet. That was up 162%. So just phenomenal growth for this company. That's never really been in question. The question is, can you actually make a profit? I'll get to that. But this is a vast majority of sales, is product sales. Service revenue and other revenue is going to be more along the lines of about 20% of the company's revenue long-term. Now, this may be a way that they can make higher margins long-term, but building out that network and having tens of thousands of stations that you're actually taking the financial risk, that's a much bigger risk business than it is just designing chargers and selling them to third parties. If we go down here to the income statement, you can see a little bit more of a breakdown of the business. Here's those product sales, and then we have charging service revenue, network fees, warranty, and other smaller items. Reasonable margins, but you start adding in the cost of these services and then host provider fees. So these are, again, the fees that they're paying to the hosts of the electric vehicle charger, network costs. Those services businesses are not necessarily as profitable as you might think. And once you take into account all of their operational costs, this is a company that has been losing money. Now, $110 million worth of operating losses includes a goodwill impairment charge of $89 million. So not losing as much money as it might seem, but definitely not a profitable company. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Where Blink starts to get a little bit more interesting is with the preliminary results that were announced for fourth quarter 2023 and the full year of 2023. So the fourth quarter revenue is going to be in excess of $42 million. Now, again, most of that sales is going to be for just simply selling chargers. But they did say that they're expecting to achieve positive adjusted EBITDA run rate by December 2024, so a year from now. The reason that adjusted EBITDA is something that we want to look at is this is going to take out some of the one-time costs, particularly related to depreciation and amortization. That would be of the network of chargers, and then also any equipment that you're having, just building out factories and things like that. So this is going to give you an idea how much cash flow is coming from the business. And so you want to be positive cash flow. Adjusted EBITDA is at least a proxy for that. It's not perfect. And depending on what the adjustments are, you want to take it with a bit of a grain of salt. But I think this is a positive step in the right direction. And the company is obviously continuing to grow with $42 million worth of revenue. So now the stock is a little bit more interesting. We're moving towards profitability. This is a company that continues to grow. I think the other charging companies are maybe starting to pull back a little bit, both on their growth expectations and now with higher interest rates, they're having to actually prove out that they can actually make money selling stuff, which is what you need to do as a company. So then we start to look at the balance sheet. And the first thing I want to look at for Blink Charging is there any major debt on the balance sheet? And they do have these considerations payable, and these are related to acquisitions that they've made. So this is a liability on the balance sheet, about $60.8 million right now. It about matches the cash on the balance sheet, $67 million worth of cash on the balance sheet. There's a small amount of notes payable, but the balance sheet by and large doesn't look too bad. So if Blink Charging can continue to grow, continue to improve those margins, lower operating costs. I want to go back up to that here just for a second, because I do think there was nice progress in the most recent quarter on things like labor expenses. So if you're able to hold most of these operating costs flat while you're growing revenue 100% per year, that's where you get to really profitable business really quickly. So we're starting to see Blink Charging move in the right direction as far as revenue growth, where the costs are from an operating side, and then also having a pretty solid balance sheet. Now, where this starts to get really interesting is when you look at what the market cap of the company is, about $225 million as I'm recording. So that means that it's trading for less than 2 times sales. A high growth company trading for less than 2 times sales, with the bottom line improving relatively quickly. That's now an intriguing investment. And that's what I'm talking about with Blink Charging. This is no longer the kind of stock where you're making outlandish projections about what the company is going to do 5, 6, 10 years down the road. Now, if the company can continue growing revenue just in 2024, get to adjusted EBITDA break even, maybe even close to free cash flow break even by the end of the year, that would be this could potentially be a very solid business. Now, I don't think that the upside is nearly what it was just a few years ago, or what investors were expecting a few years ago. The upside for this business is that they're going to be a really solid electric vehicle charging manufacturer. Maybe they even build out some sort of network themselves, could even be with the help of someone else. But I don't ultimately think that owning a charging network is going to be a hugely profitable business. And that's simply because you're selling electricity, a commodity, through the same plug as everybody else, the commodity NACS charger that most of these companies are moving to. And that's where all manufacturers are moving. So now there's going to be really no difference between a plug charging plug versus a charge point plug versus a Tesla plug versus any other company that's creating a charger out there. Those sort of commodity businesses are not the kind of businesses that deserve a massive multiple, but they can be the kind of businesses that can be profitable manufacturers of products, goods, and services. So that's where I think ChargePoint really gets really interesting, because this is ultimately a growing market. There are going to be needs for more and more chargers, whether those are commercial chargers or residential chargers. As more electric vehicles are sold, these networks need to grow, and that's going to be tailwind behind plug charging. What the company needs to do now is prove that it can profitably sell the chargers that it's making today. I don't think that investors should expect Blink Charging to lose money now in search of some sort of profits in the future. This is a company that needs to be profitable now because it's ultimately a manufacturing company, and that's where it gets the core of its business. If there's some sort of upside in owning a network and owning service stations in the future, that's great. But it needs to be a profitable company now. And given the current market cap, reasonably strong balance sheet, and improving financials on the bottom line in particular, this is now a company that I'm much more intrigued by than I ever have been. Not yet ready to buy the stock, but I want to hear what management thinks after the fourth quarter results are announced, and watch this company throughout 2024 because there could be untapped upside with Blink Charging. This is a big shift. I've not liked this stock for a very long time, but when a stock falls over almost 95%, you got to change You have to change how you look at it. And I think I think investors should do that because management seems to be changing how they're operating the business as well. So worth a second look if you haven't looked at it in a while. What do you think about blink charging? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.